All right, what's up, family? Welcome to today's analysis. So, first off, I wanted to make this video for both. It was supposed to be specifically for the Lazarus members, but then uh, because I wanted to like blend the today's discussion with both the new members, new Leo's members, and also the more advanced members, which is basically Lazarus members. So, no, that's why I'm just gonna make this available to all of you guys. I'm gonna restrict so you guys cannot share the video uh, because again it's advanced content. So if it's the basic level stuff, I'm fine with you guys sharing. But if it's advanced, then obviously it's gotta stay with us. That's number one. Number two, a lot of you guys missed the call I did, and I'm sure a lot of you guys are not going to watch the basics call I did, which is fine. To be honest, I was really disappointed. There's only like 7 people on the call because I wanted to talk to all of you guys. But it's fine. So just an announcement for those of you guys who are Lazarus members, you're gonna see that you're probably the role has been deleted from you, or you're no longer a Lazarus member. So, all I want you to do is just reach out to me on any of the social media platforms, preferably IG or Telegram, and for me to verify you back in the program, and I'll do so. So Nick is no longer verifying anyone, so don't no need to reach out to Nick. I'm bringing a change to the program, and I want to make sure that's as secure as possible. So I want you guys to reach out to me, and I'll verify you guys myself back on the program. So yeah, that is for the Lazarus program. Now let's get into today's discussion, which is this: the market maker model. Okay, now the market maker model is one of the more powerful models in the markets. Now it's so easy, which is something I used to do before when I first got exposed to this like 3 years ago. Obviously, I did not invent this. It's obviously the master himself, ICT. Learned this from him a couple years ago. But before that, before learning this, I was exposed to stuff from Wyckoff and also Dow. And initially, when I saw the market maker model, I thought it was derived from Wyckoff. So that was my initial false bias. So that was a false bias I had initially. And I thought, okay, this is some Wyckoff model type thing. So this obviously is a Wyckoff model. But then over the years and the experience, you would see that if you go and look at Wyckoff, there's no specificity to Wyckoff. It's more just generic stuff. It's just like a bunch of lines and just know when to pull the trigger to get into the move. It's just none of that stuff, which is something the market maker model, you know, completes. So it's a complete model that you can apply to price. Now, so many people think that you can only use this in a small time frame, like 15 minute time frame, 1 hour time frame, or a 4 hour time frame, which is false. You can use it on any time frame. You can use it from 1 minute time frame all the way up to a monthly time frame. It's on all time frames. It's only for you to see the model, and the model is one of the ways that one of the ways the market reprices after an overextended move or after a move to a specific level. Now, in this move here, because I have a journal, I'm running a personal journal, so a lot of stuff I teach the Lazarus members, they are from my personal journal. So you're gonna see, you can see tape reading. This is my personal journal where I do all my stuff, and so this is something I was one of the things I was working on, which is this. So I was doing an analysis of obviously euro dollar and the weekly time frame. You can see we have a level of inefficiency here to here. Okay, that is the level of inefficiency. And I was watching that. That was when I was here in my analysis, just watching that to see if price met that and if there was a possibility of price trading lower into this. Now, obviously, I knew that we were trading within this last two down candles, which is a weekly trade block. Now, we're trading down to a level of discount. Okay, between this range is low to high, it's a level of discount, obviously. Now, what I was thinking to myself was, do we continue to trade lower, or do we consolidate, or do we reverse altogether? Now, those are the potential things that could happen whenever you get to a higher time frame level. Now, we fell short of the level just by a few pips, but we basically almost closed in the level, right? So you can see higher time for target, weekly buy side inefficiency cells, buy side busy buy side efficiency cells like I don't know. I don't know why my mind is skipping the words. I apologize. It's buy side something Apple's festivals. It's buy side something else or something. Okay. So yeah, it's a weekly busy, which is a just a, is the type of a bullish or value gap. So that's what a weekly BC is. So for those of you guys who are new and you're asking what a BC is, I don't know why my brain's keeping the full meaning. Or it's like buy side inefficiency, sell side imbalance. Yeah, it's that. So buy side efficiency, sell side buy side imbalance, sell side inefficiency. Excuse me. So there's an imbalance of buy side liquidity. Uh, Let me see if I can find an example here. So this will be a CB. This would be a sell side imbalance, just an imbalance of sell side, and it's inefficient on the buy side. Okay, so the larger the candle or the larger the inefficiency, then it's a CB. If it's a smaller one like this, it's a fair value gap. And what is the difference between a fair value gap and a CB? What is the difference between a bearish fair value gap and CB? It has more sensitivity. That is something you should be taking notes on and getting absolutely excited about that I just revealed to you. Okay, the difference between a fair value gap and a CB is the fair value gap is smaller in magnitude but has more sensitivity versus the CB, which is larger in magnitude. Okay, and yeah, and the inverse for a BC, which is a buy side imbalance, sell side inefficiency, which is what we have had on the weekly time frame here, and that was what was completely filled. Now, whenever we're trading from a level of premium macro time frame, which is this is a daily chart. So whenever we're trading from a level of premium on the macro time frame to a level of discount, okay, once we get to the higher time frame target, we can do two things. We can, three things actually. Okay, I don't know why I started this. Sorry for that. It's just clicking all over the place. But again, clicking this. Let me just get rid of this real quick. Okay, done. Let me get rid of this. So now whenever we get to a level of an higher time from target, we can either move sideways, and whenever you see price moving sideways, it's sucking in liquidity for the next move. So it can go sideways, it can pause a little bit and then continue the trend, or it can reverse altogether. And what we're talking about is the reversal profile, which is where the market maker model comes into play. So this is a daily reversal profile utilizing the market maker model. Now, obviously, it took me a while. I was able to day trade this as a buy, day trade this as a buy. I got this absolutely wrong. Did not take a loss on my analysis, but it was wrong. That was this. And I did not foresee this one. Actually, I did. After, when we got here, that was when I started looking for buys. But Monday, I was bullish. I used something called chain sale delivery, which I teach to the Lazarus members. A lot of you guys would have gotten sucked into this market and they've lost. And that's the benefit of the Lazarus program. So I was able to get a profitable setup. Might as well let me just show you guys real quick. So you guys can see that. So that was that Monday's price action. When I was in my back testing, you can see I was able to take a long here using change to delivery. I was able to take another long here on Monday, which is this price action. And Caesar was able to do the same thing. It was really this was a very difficult market. I was able to catch something in that market. This is Tuesday. You can see me documenting this, looking at S&P divergence and saying, okay, I don't want to see this be within the other block and all of that, which I encourage you guys to do. So I encourage you guys to journal entry. And I had my entry off of a 1 hour bounce price range plus a change of delivery plus a mitigation block. You can see the result of that. But on Wednesday, I think I got it wrong. That was this. So I was looking at this as the run about short to my and not necessarily got it wrong because I was able to take partials off of that setup. You can see this is the entry there, and this is the outcome. Trading looking for equal lows. I was thinking I was going to get down to this and then continue the trade lower into discount, but I just got sucked in price. to lower, move myself to break even, and then I got sucked out. So this would have been one of the situations where I would be looking for a trend line, and this is where the trend line can work in situations like this. Now, I was blindsided by this move from here to here, but this is something I was looking at if we could get a potential continuation to the upside by missing interest. I was looking for something more like an institutional financial drill. Uh, that was here. I was looking for that institutional financial drill. But then again, we missed that, and this is something I'll talk about, which is a measuring gap. Okay, so this is characteristic of a measuring gap. Typically, they get remain in play, and yeah. So I think I talked about this on the last spring. So this is sort of the move up into the gap, take it up to the top of the gap, and then from the bottom of the gap, you extend this out, and you can see it's a measured move. Okay. Oh, this is new stuff. Yeah. So, I taught measuring gaps a long while ago, so you can go and practice this. Now, again, that's why I'm saying a lot of you guys is still your knowledge and stuff like this is basic. Like, still have basic knowledge. Why am I clicking on so many random things? I do apologize. I'm just all over the place. So whenever you have a market maker model, right? Um, what you're looking for is to pair up the left side of the curve. Now let's go into market maker models. Okay, so I'm gonna use this chart. Let's use something like, let's use the Swiss franc futures contract. Okay, because I don't really look at the Swiss franc futures there, so we can just drop anything in this, and it's fine. All right, so. All right, so a typical market maker profile is typical market maker buy profile is you have your initial consolidation, okay, then you have your run down to your high time frame discount. This is the low risk sell. The best area to sell short will be here. Then you have your reaccumulation where there's more stacking of orders from the in the bank market, and then you get down to your time frame level. Then this is where you have the reversal. And then you have your low risk buy. Then you have your reaccumulation. And then you have your run on liquidity, which is this. So this is you want to have this diagram shape. This is your initial consolidation that starts your downtrend. Okay, this is your run to support. The market maker model is simply a hedging profile from the banks, from the central banks. It's a way for the central banks to engineer liquidity and hedge into liquidity. So typically, what's going to happen is when we get to a higher time frame discount, just like what we have in this example, where we've gone to an higher time frame target, which is the weekly buy side imbalance, sell side efficiency. So I'll go out to the weekly time frame and you guys can see this. Okay, that the red lines, horizontal lines, delineates the weekly inefficiency, and then we trade down into that, and then we trade up. We have that beautiful reaction. So going out back out to the daily time frame, right? Now, what we have right here is the consolidation where we have sell side positions accumulated and sell side liquidity being offered. And here we're engineering sell side liquidity offered so the market maker will take the opposing side of the market. So they offer sell side liquidity inside of this range. Price declines, offer sell side liquidity inside of this range. When we get down here, they begin to accumulate buy position, more buys, and then they start distributing longs from here. So from here, as they distribute longs, they're mitigating accumulated positions. You're mitigating accumulated positions. So inside of this, okay, you're looking for the candlesticks to the left side of the curve, and you're matching that with current price action because that's where the banks are going to make it. So now let me show you how it looks like on this time frame. So simply what I did on euro dollar was to first identify the bearish hollow blocks. Okay, so this is the left side of the curve. This is the right side of the curve. This is your market model. You have your initial consolidation, which is this. You have your lower sell, which is this. It's one candle, but still a lower sell. Okay, you have your lower sell. Why is this a lower sell, Jenny? Because it's within a breaker block. We're on a short-term high. It starts from this. So this is a lower sell within this profile. Okay. Now, from this high to this low, there's a larger profile in play. But from this high, intermediate term high to this low, there's a smaller daily profile in play that we utilizing for the central bank hedging program. So this is a bank hedging program from the central banks. Okay, this is how they offer liquidity on the daily time frame. So we have the initial consolidation, we have the lower sell, which is this candle. So inside this up, remember the smart money sell in down candles or the selling up candles. They sell in up candles and they buy in down candles. Okay, so this is a footprint of them offering sell side liquidity. This is the footprint of them offering sell side liquidity because it's not retail that makes this up candle go bearish. It's central banks. It's not retail that makes this up candle go bearish. It's central banks. It's not retail that makes this down candle go bullish. It's central banks. Okay, it's not retail that makes this down candle go bullish. There's a reason why bullish order blocks are valid. Okay, bullish order blocks in a bullish market indicates institutional order flow. Okay, the institutions they're sponsoring price one direction. In that bullish order block, liquidity is being offered. No one teaches you this one. Teach me this right now. Liquidity is being offered here to the institutions. They buy here, boom, price goes up. Just a little bit of a gap here. Interbank order flow. Again, this is very complex stuff. We're going to talk about this later. Interbank order flow price will remember these prices. Okay, I think I'm joking. Check this out. Extend it out. Boom. Extend this out. Okay, the bottom of this, you can see trades up into that plus propulsion blocking threshold, sells off, breaks below, trades up into this, trades back up into this, sells short. Interbank order flow. Interbank order flow is different from institutional order flow. Okay, institutional order flow is this. Institutional order flow is the provision of liquidity that sponsors a trend. Okay, that is institutional order flow. Interbank order flow is the efficiency of the market at interbank levels defined by market inefficiencies. Complex stuff we're going to talk about that later on. So that is way advanced stuff. That is advanced level 10 stuff. All right, so now going back into this, what you're doing is you want to take the opposing candle, extend that as a range, and you're looking for mitigation inside of that range. Take the opposing candle, extend that as a range, you're looking for mitigation inside of that range. Now, also you look for the inefficiencies. Okay, here we have a bearish value gap. You extend that out because once price closes in on that, it becomes a balanced price range. And balanced price ranges, just like I teach, your natural levels of support and resistance on an interbank perspective. This is interbank order flow. This is a bearish value gap. Price closes in on this. This becomes a balanced price range. Bearish value gap. Price closes in on this. Because the moment price fills this in, that is a balanced price range. The moment price fills this in, that is a balanced price range. So you have balanced price ranges on the right side of the curve, and you also have mitigation blocks extended out to the right side of the curve. So now let's go out to the 1 hour time frame and see the response of price to there, to those levels. Okay, this is a daily balanced price range. Look at the accumulation inside of that daily balanced price range. We sell up, we take partials at this daily bearish value gap. The moment price closes on that, you can see it becomes a balanced price range. Trades up in the balanced price range, natural resistance sells off, trades up above natural resistance, trades down into the balanced price range, which is now natural support. We go higher, we trade down here. But look at the bodies. Why did price reach this deeply into this? Because we have an inefficiency from this kind of 6 high to this kind of 6 low. Extend that out, consequent enrichment, boom. The moment it goes up, which that was something I missed. Okay, I was able to catch the sell move as a Thursday from here to here, but then I missed the move going bullish. Price trades higher. You have institutional influential drill. We closing in this gap, deferred delivery, we extend up. So that is when I say deferred delivery, I'm simply mean deferred value. And then we extend up to the upside. Now look at this. What is this? What is going on here? Okay, what is happening there? Why are we consolidating here? For those of you guys on the last screen, I'm going to give you guys a few seconds to tell me why. To say it yourself before I give you the answer why we're consolidating there. All right, we're done. If you pull your Fibonacci from the bottom of the mitigation block, the daily mitigation block, excuse me, from the bottom of the daily mitigation block to the daily mitigation block, you can see this is the consequent encroachment, not the consequent encroachment, the mean threshold of that daily mitigation block. Okay, so when we're using all the blocks and we're using uh, mitigation blocks and breaking blocks, we use mean threshold, not consequent encroachment. Consequent encroachment is for inefficiencies. So you can see price trades up into the consequent encroachment of that daily mitigation block, sells off, trades back up there. Once it trades through, it begins to accumulate there and then expand. This is typical smart money footprint. We expand out of the range. I just mentioned that this was a measuring gap. Okay, and that was how I was able to predict from this low to this gap and then from this to this, which is basically an A to B, C to D type move. Once we extend out to trade through this daily fair value gap, look at the response there. Trade down into that, trade down into that, coupled with a 1 hour inefficiency. Okay, 1 hour inefficiency at a discount. Again, we don't want to see price trade into this because that is a measuring gap. Okay, discount from the low of this range, low to high. We have a discount, trades down into that, boom, explosion back to the upside. This is smart money footprints. This is real interbank trading. Okay. So I wanted to do that for you guys because that was something I was looking at. So hopefully this was insightful to you guys all. I'll let you call now and I'll see you guys all tomorrow. Safe.